everyone, and thank you for joining us here at WWJ News Radio 950 in Detroit and also CBSDetroit.com. I'm Murray Feldman, Fox 2 and WWJ's business editor. And today on this Financial Fitness Thursday, we're talking about what happens when things out of your control are happening around you. We've been talking in the news about earthquakes and about tsunamis and about political unrest places, and now you have money on the line. Every time we mention that on the air, every time a financial analyst mentions that, the market goes up, the market goes down, and you're caught in the middle. That's where we begin this discussion. What's your best plan of attack? Mark Robinson is here, certified investment management analyst and developer and lead presenter of the popular Investor Education in Your Community series. He's been all over Michigan doing that. Katerina DeFalco, certified financial planner and certified wealth specialist, is with us as well as we begin to figure out what we do with our money and how we get to the places that we need to be many, many years from now. It's a big topic, a lot of stuff, Kat, to talk about. Let's lay it all out.
Thank you, Murray. We are in a particularly volatile environment today, and what we would like to share with our listeners today are some tips on gaining some control, avoiding common investment pitfalls, and ways to gain an advantage and avoid some unnecessary risk.
Yeah, so where do we begin and how do we get ourselves started?
Murray, we need to deal with right now. So we need to get a control, get ourselves into a space where we are handling right now, and in doing so, manage the future.
We need to take a look at fundamental insight. The only way to deal with the future is to put yourself, as your slide says, in a space where you are functioning effectively now.
That is it. How do we do that? Well, we have a 5-step process that we're going to go through today with you. It starts with organizing the facts, stating your goals, creating a strategy to achieve your goals, stay in control by putting this in writing, be aware, stay informed, be adaptive, and measure your progress periodically.
And the first step to getting control is to know where your money is. What do you have? What types of accounts do you have? Do you have an IRA, company savings, 401k plan, a regular brokerage account? And note that each type of account can offer some unique benefits. You may have a company match in your 401k plan, and we don't want to leave free money on the table. An IRA will offer a tax benefit by allowing a whole dollar to be invested instead of 70 or 80 cents, for example. So that's the first step. Know your facts, take an inventory, if you will.
Know what you have in all accounts everywhere. So many people have different accounts places and they're not really sure what kind of accounts they are. People say, well, I have an IRA, but I'm not sure what's invested in that IRA. They don't understand that an IRA, for example, is like a box that you fill with something that you hope will grow and fill up that box someday.
Unfortunately, too many people have too many boxes.
True.
Right.
And so part of our advice is to consolidate where that makes sense. It increases the oversight capabilities over your portfolio, as well as often driving down the costs of managing your money and overseeing your money. And in this low return environment that we are in, we need to put that 1 or 2 extra percentage points on our side of the ledger. And these are just oversight issues. So this is very important here, just organizing the facts. Where am I and why am I there?
And then, of course, you have to say, what do I want this money to do for me someday? What do I want my goals to be?
Sure.
We have to go out there and set some goals.
Absolutely. So we have to find out where all of our accounts are, know what boxes we have, make sure they're the right boxes. It's a little bit of the boring part, but it's a necessary step. Then we are going to take an inventory of how much money we've saved. How many dollars have we already collected for our goals? Then we're going to talk about our goals. What is important to us? Saving for retirement, education, and understanding that you may have some expressive goals. There's not dollars attached to that. For example, you want to be a socially responsible investor. That's important. That defines what kind of investor you are.
When we say that, we are reminded that there are many investments that are geared towards socially responsible investors. They are green companies that they invest in and green causes. We'll get to that a little bit later when we continue this presentation here. But the step, of course, is to know your goals or your mission, know what you need to save for and the time frame about that stuff.
And prioritize. When we write down our goals, we may find we don't have the resources necessary to attack all of our goals at once. So then prioritize, deciding what's important first and in what order you're going to address those.
All right, and it's all about, moving in the right direction and creating that strategy to use those investments wisely. A great investment for me might not work for you.
That's true. Now that you have figured out what you have, you can start designing your investment strategy. I mentioned the first part is a little bit boring, but we're going to get into the fun part now. It's also the tricky part. I say it's the tricky part because of common investment pitfalls, and we have a very interesting chart to share with you. If you'll notice over on this chart, over the past 20 years, the market has averaged 8.2%, while the average investor has averaged only 3.17%. Why is that?
Not
to you, Murray. We know why.
but I want to just stop there for a moment because
Yeah.
we are watching your questions come in, and I know we have a question on there. We were talking about that on the radio because it's an incredible number there, and the viewer here and the listener here wanted to know what time frame we're talking about. That was over a 20-year period.
But
that's a decent horizon for an investor to take a look at. So over 20 years, you want to make a little bit more than the 3.17.
What also is important about this, when you look at building wealth, which is why we're in the markets, money doubles at 8% in roughly 9 years. At 3%, it takes 24 years. So if what we're trying to do is build wealth, Murray, we're not helping ourselves.
Right. So here's the problem. We see the market does this, or the averages are here. Ours is here. What pitfalls have we hit? What happened along the way that led us astray?
Well, there was a Nobel Prize awarded in 2002 by two economists who looked at how we as humans or investors make decisions during periods of uncertainty, which is certainly the stock market. And the distilled findings of that were this: we become overly confident in our abilities, which means often we become overly concentrated in areas that we understand, which means we lack the diversification. We overweight recent experience. 1998, 1999, early 2000, we thought the markets were going to continue to go up at 30 or 40% a year. What were we thinking in 2003 and 2008? Well, the markets were never going to come back, which often had us being either too cautious or conservative when we ought not be, or overly optimistic and maybe a little bit too much into the risk categories when we ought not be also. Other things are mood swings. We're always affected by the markets. It's an emotional thing, being invested. And so that causes us to sometimes knee-jerk react into and out of certain investments. And frankly, the media is a big part of that, where often we will divert from sound investment strategies based more on a long-term approach, and we start knee-jerk reacting to sound bites that we hear, either to jump into something or avoid something completely. As you and I were discussing, there is a big difference between what is interesting and what is important. And most of what is reported on the news media is very interesting, but is it important and something that I ought to be acting on in my portfolio?
And when we take a look at what has happened and the events that we have no control over that you're just talking about and the things that cause the knee-jerk reactions, we have to remember that not every year is going to be an up year. There are years that are going to be much better than others.
That's right.
And if you look back over all of the years that have passed us in one's lifetime, there were good and there were bad. And the best thing to do is to get the best that you can out of the total package.
That's right. And here's where this gets interesting with how we view the markets and some of the anchoring and the projecting that we do. Be careful with projecting out rates of return. And you look at this slide and you look at the rates of return by decade, and you see that they're all over the place, even though stocks have averaged over this period about 9.8%. Your experience was very different in the 80s as it was in the first decade of the new millennium here. And though stocks might average 9.8%, these aren't independent, all of these 80 or so independent data points. They're not. They're really skewed by three markets that we had. A bear market back in the 60s and 70s, a raging bull market, and then whatever market we're in at this point, a cyclical bull market within a bear market, we don't know yet. And so it skews the numbers. As it's graphically illustrated on the next slide here, you can see where we go through periods. Though the markets average 9.9, folks that were saving during their saving years of their 40s and 50s back in the 60s and 70s had a totally different experience than those that are saving now or in the 80s had a completely different experience with the stock market. And so, though we average 9.9%, average probably won't happen for you, as we can see by this, because of the dispersion of how the markets deliver. Summarized, stocks deliver in clumps. They don't give it out in smooth rates of return. So they're in trends, and we call these cyclical or cycles. Cyclical markets that are driven by long-term trends, geopolitical issues, political global events. Cyclical that are shorter term and can actually pop up within a secular trend. For example, a bull market within a bear market. Problem is, you can't control which market you're investing in.
As you bring that up, let me just sidetrack for a moment. And I'm reminded of the many people at our investment seminars and our money summits that we have done here through WWJ Radio. Many people have gone there and they said, I heard the market really soared last year, but I'm still down. Well, are you down because you pulled out when things got bad, which is the knee-jerk reaction before? Of course, nobody wants to go to sleep every night and hear that the market dropped 100 points or 200 points or, as it did several years ago, 600 and 700 points in one day. But the point is to average it out and to take a look at market trends, take the best of both worlds, and you have to do that by having a plan, as we talked about before, and knowing when to invest and how to invest.
That's true, Murray, and you bring up an excellent point about emotional-based decisions, not to make decisions based on your emotions. So we have a 5-step process that will hopefully help us protect us from ourselves a little bit, if you will. The first step is to know your goals, know what you're trying to accomplish, and this will help you determine your time horizon, which is critical to know. How much time do you have to achieve your goal? If it's retirement, for example, you have likely a very long time horizon, 20 years perhaps, and if you're saving to buy a new car, maybe you have 2 years. Looking at this next chart, would you want your short-term savings for a new car purchase, for example, in a stock portfolio, looking at the range of return that a stock portfolio can provide? Too much volatility.
What this also says, forgive me for jumping in on you, is that a very good investment like stocks, when measured over a long period of time, can really put the hurt on you if you're trying to help yourself over the short term. And you have some statistics on that, or some thinking on that.
Exactly. I was going to mention, what if it's 1990? You're getting your statements in the mail, you're making money hand over fist, your stocks are doing extremely well, you're saving for a new car purchase in 2 years. You think, I'm going to put that money in my stock portfolio, and I'll make a lot of money very quickly and have the money I need for my new car. Then we go into a 30% correction. You don't have time to recover from that. So being careful not to put too much emphasis on recent experience is another common pitfall.
All right, you may see me looking away from Kat and Mark, and it's not because I'm not interested. I'm keeping an eye on what you're saying on the website here, cbsdetroit.com, and we're trying to look at some of the questions that are coming in, and we'll be answering them throughout this session here. And here's one from Mike S. Given Michigan's economy over the past several years, we haven't been able to stock up on our safety fund, 6 months salary, and now with gas prices approaching $4 and the cost of basic groceries higher, I don't know if it's better to invest in the market or put my money in a savings account to build up the safety net. Not enough money coming in to do everything. What should be used to make these decisions? That's a great question right there. Where do you put the money? What is most important?
And it's touching on so many points that we've already mentioned today. Knowing your goals and prioritizing them. Generality in financial planning is that you should pay off your debt first, establish an emergency fund second, then you can start your investment strategy. So definitely having money set aside in a savings account, in my opinion, is priority to beginning your investment strategy.
And when you talked about the car, and where should I put that money, we're also talking about a risk factor here too.
Yes, definitely.
And a risk factor is something that's in all investments. It depends on how much risk you can handle and still go to bed every night and get a good night's sleep.
Exactly. Yes, there's no investment without risk, just different degrees.
So the question is, how much risk do you need to get your objectives?
Exactly. And the operative word there is need. How much risk do you need to take? here's another example for you. If you're near retirement and you calculate that you have enough money already saved that you can afford to earn 5% to generate the retirement income that you need, you don't need to take a lot of risk. You can afford to be in a bond portfolio, for example, that may return 5%. A stock portfolio may return closer to 9%, which is nice, but if you don't need that kind of return, don't take the risk. Never assume more risk than you need to.
And if it's short-term money or for a short-term goal, you certainly wouldn't want to put it in stocks and want to pull it out for a down payment on a house next year, because the market does go up and down, as we have seen before.